Yo, welcome back to YBI, where we discuss the ways and strategies on how to better your financial selves. It's Zion, coming to you from a little bit of a different space. But that is because we had the opportunity to sit down with Dr. Pam Ross, an absolutely phenomenal person. She's a dear friend of ours, and we had the opportunity to sit down with her on the Culturalist podcast, where she hosts a absolutely great conversation-based podcast. And we came on and talked about all things finance. We talked about a lot of things when it comes to your tax returns. So it's going to be a great conversation, but we had to give her the proper intro. For one, she is a mentor, she is a coach, she is a doctor, so she is absolutely brilliant. But she's also an author of the book, Get Ready to Fly. You can find all of her links down in the description below, but she is at pamross.com. So make sure you guys go check her out and enjoy the conversation to come. And if you see a little, my lights going off, don't worry about it. All right, enjoy the show.
Hello, gentlemen.
Hello.
How are y'all doing?
Fantastic. Fantastic. How are you?
Feeling good. Feeling great. Me too. I'm actually feeling pretty good. Folks have been asking me, somebody called me yesterday and was like, how are you? And I said, I'm all right. And they said, you don't really sound like you're
the question mark on there? Yeah.
Yeah,
the question mark.
Right. And I think I was receiving it as a real question rather than as a greeting. Because, particularly in my community, I think it's a little bit more of an East Coast thing as well. How you doing? It's simply a greeting. How you doing? Nobody really gonna ask you about your last physical. They just want to know. You all right? I'm good.
Yep.
Well, thank you so much.
The sky is not falling.
The sky is not falling, and I'm still here. I'm still in the ring. I'm still throwing punches. I'm still winning. So yes. So it's a good day, and I'm excited to talk to you guys. Roman and Zion. First of y'all have really cool names. I'm excited to talk to you guys about one of my favorite topics, and that is money. Because the more money the more money you're around, the more people talk about it. Like it becomes not so much of a big deal. So here's a completely out of your expertise question. What's your favorite nickname for money?
Ooh, moolah.
Moolah.
No. It's definitely the
dough. That bread.
Roman, yours is
moolah.
That
bread. Yeah,
bread.
moolah or bread. Yeah, one of the two. Because nobody uses moolah, so it's like
nobody does. Yeah, nobody says moolah. No, not too much. Moolah
and dough. I'm into the dough.
You're into the dough, so you're into the bread. The dough.
I'm into the bread.
Where is it? Give me the naan.
There. That's
Give me the naan
right there. Yeah.
I think that's gonna be my new favorite. Give me the naan.
They're just going to start actually bringing you bread. That's what's going to happen. They're literally going to bring you bread.
Give me the naan. What's up with the money? I think my favorite one, man, what do I say? I always say to my kids, now, I'm pretty old. So what I'll say, sometimes I'll be like, don't forget my cheddar.
The cheddar? Yeah, my mama says that.
The cheddar's a good one.
That's my mom. That's my mom. Yeah.
That's my generation right there. Don't forget my cheddar. Put that cheese on top, right? So how did the two of you guys meet?
Go ahead, Roman.
High school. Back in the day, a good old high school days.
Wow. So when you met, were you both smart guys? You strike me as those kids.
So
I would say we were pretty smart.
So Roman was the person at our high school that was selling candy and snacks out of his locker. And I was the person that always needed candy and snacks. So,
so it was simple relationship built by supply and demand.
Yeah. He knew what I needed.
Simple economics.
Economics.
He had the connection. I just was hungry all the time, so we had just been boys ever since then.
So you became your best friend and your best customer. I love it.
Yeah.
And then how did it grow from high school friends to now you are colleagues working together on this amazing podcast? First of all, I love the name Young, Broke, and Investing. I love it because that combination is very interesting, and we'll get into that. But how did it evolve from we're friends that met in high school and now we're doing this?
Well, I think that the vision really came from Roman, like probably 2-3 years ago. But I don't think that we ever really lost connection. Like we've always lived in the Chicagoland area, and we would always be, texting back and forth just about little things and stuff like that. And we always just stayed connected. But we've always just been like interested in the same type of stuff. So we would always be hanging out. He would always be like, hey, just come to the house, do this, do that. And then as our lives grew, like I got married and I had some kids and all that, like we still were like, we have to keep this connection, this brotherhood alive. And then YBI came from him. The vision came from him. So Roman, where did it come from?
Where did it come from? And where did you get this cool title?
I got dropped. Somebody got dropped.
Oh, no, you're back.
Yeah, you're here.
I'm back. Okay.
Yeah, you're back.
Okay. I didn't hear the last thing you said. I'm sorry.
Where's this vision of YBI?
It really came from a wanting of myself to really just get more involved in just financial literacy and investing, and wanting to stop kind of working for other people and always trying to like just live to work. And I didn't see a lot of our faces and the people like us that was really speaking about it and talking on it. That wasn't honestly just get rich quick schemes. I wanted something else that's like teach me what money is, show me how to do it from start to finish. I just need to get a general understanding about this. And I was like, well, I'm young, I'm broke, and I'm trying to invest. And I think I was bouncing ideas kind of off of Zion, and then we kind of just settled on that one. And it perfectly with it.
I love the idea because, you want to title something that people can relate to, and not just say that's you, but also say, wow, that's me. That's the situation I'm in right now. So I think your title perfectly identifies your audience. Hey, if you're young, broke, and you're interested in investing, this is the podcast for you. These are the hosts for you. Now, how young are y'all? Because you look pretty young to me. Old enough to order a pizza, but you look pretty young to me.
17,
I'm 28.
18? Yeah, I'm 29.
I'm 28. He don't lie about it. I'm 28.
Y'all are 28, 29, right? Still in your 20s. And this is what I think is really interesting. Most folks in their 20s are looking at how they're going to spend their money. Mm-hmm. They're working for money. Yeah. And they're not necessarily interested in helping and looking at their money working for them. Do you find that to be true?
Absolutely. I think that what has happened is one reason why we wanted to start the podcast is because we saw that stigma of people like, as soon as I get my first check, as soon as I start making good money, I want to go and spend it and live,
I want to buy. I want to
live that lavish life early on. And we wanted to start implanting in people that let's do it in reverse, where you start saving your money early, you let that money compound, you let that money grow for you. And then when you're 45, now you can do whatever you want to do. Everybody else is going to be struggling to, purchase a home or struggling to continue to work. And we're like, we want to be ready to retire super early. The earlier you get started, the earlier you're going to be able to start relaxing. And having that mindset is the same mindset that I want to implant in my children, but in the next generation. So people that are listening to us, we're like, hey, make sure that you start doing this, because if you look at the trends of when you start investing in things like 401k or things like that, the gap of the amount of money that you'll make is exponential.
Just waiting 7 to 10 years. When you look and say, man, if I started 7 to 10 years earlier, I would what?
Yeah.
Rather than Florida, it could be Venice.
Mm-hmm. Yeah. And we very much push the fact that you don't have to not spend money on nothing. You still can invest in yourself, and there's ways to do that without breaking the bank. And you can still take care of yourself and have a good time and still be happy without being like, I got to eat off of rice and beans my entire life. So people think about those two separate worlds and think, to save money, I got to take out everything. You don't have to do that. It's just being smart and thinking about where your money goes.
And this idea of all or nothing, either I'm saving it all or I'm spending it all, you're helping folks come right to the middle. What's your definition of broke?
Definition of broke is temporarily without money. It's literally just the mindset of being like, okay, I may not. It's the concept. It's not being like, okay, like maybe I don't have that extra $200 to buy that next concert ticket, but all my bills are paid. It's just having that little change of mindset of being like, but I'm fully invested, but maybe I can't go out and spend $100 on drinks, but I just put $50 in the stock market. It's just having kind of different mindset of that. And I'm saying, this is only temporary. Eventually, though, this is gonna keep growing. And I'm gonna be very plentiful.
Yeah, it's interesting to be broke with options.
Mm-hmm. Yes.
It's the idea of broke versus poor. That's the idea that we went through.
You're out of options.
Yeah. If
And
you're
when
broke, I
you're
mean,
when you're
we got to
broke,
change mindset.
yeah, changing that mindset of if I'm not keeping up with folks. I think what I'm hearing is the crux, like the core of what y'all do as finance. I think you're more than podcast hosts, and you know that. It's like you're financial revolutionaries, and even this idea of changing the way people think and feel about money. And that the fact that none of this stuff, now tell me if it's happening now in school and I don't know about it, but I was a math kid. Like I was such a math kid. I took all the math courses, then I took the advanced courses. I became the statistician for the ball team. Like I was just straight up, I loved math. But nowhere did anybody teach me about money, compound interest, and investing.
Yeah, it's like, where is that in our that's really the really lack of it there, is where is that in our education system as far as teaching all young people just how to live and how to be an adult in that sense, how to file your taxes.
How to file your taxes, how money works. And most people, when it's time to file their taxes, they just think about, I'm gonna get this tax return and spend it.
Yeah. Yep. Yeah. That's part of the problem. That's part of the problem. But people love that. People love that. People are literally waiting. So in my daily profession, I'm in the accounting department. So I was just like you. I loved math. I took 7 years of math in my 4 years of high school.
Yes.
Like I loved it. So in the accounting world, people are coming to me constantly asking me about this type of topic, like what do I do, and how I'm so excited about my tax return, and I'm like, well, if you're getting a large tax return, you probably didn't set up your taxes correctly in the first place.
What?
Like, what are we talking about here?
So
we on it.
So when you plug in all the numbers, because most people are doing theirs online, or they're with, most folks don't have to hire an accountant, unless you got money going and coming from a lot of directions. Then you need an accountant to make sure you're not leaving any money on the table. Right. But most folks plug in all that money, and when they see that tax return big, you're saying, oh, you did something wrong.
So it's not necessarily that they did something wrong. It's that they set up their taxes incorrectly. So when you first get hired on a job, things like that, you're going to fill out a W-4 form. And that W-4 form tells you about your exemptions and things like that. And the higher these numbers go, the more money that you're going to get. And at the end of the day, when you file your taxes, if you're getting like $14,000 back, $10,000 back, that's money that the government has taken from you that they shouldn't have. It's pretty much you gave the government a interest-free loan on your money, and then they're just going to give it back to you, rather than setting up your taxes correctly to have the appropriate amount of taxes deducted from you. So by the time you actually do file your taxes, it's close, like you want it to be minimal. Like I'm not saying that you want to owe, but it should be like $500, something like that. Yeah. Because if I loan the government $500, I feel a lot better about myself than if I loan them $5,000. Because if they loan me $5,000,
that refund is the amount of money. Basically, if we think about it, to put it in layman's terms, that's the amount of money you were overtaxed.
Correct. It's a refund. It's exactly the definition of it. It's money that you overpaid for, and they're giving it back to you. And when you get extra tax credits, that's a different story. But those are okay. Tax credits are stuff you get from child tax credit, EV, buying an EV car, other things like that. That is money the government's kind of just giving back to you on top of that. So that's a different case in those points. If you or your accountant kind of works that in for you, even better.
Yeah. So when you're filling out these forms, because I've had people come to me and say, what should I? And I wasn't the HR person. I was just like staffer or chief of staff at the time, but it wasn't, I don't know anything about that. I'm online trying to figure it out myself. Can you give us the simplest explanation of how to approach that particular question? How many exemptions can I take? And how does that even work for me?
The simplest thing that you can do is read the form.
Okay.
Just reading the form.
Reading is fundamental.
Yes.
I hear you, LeVar. I hear you.
Reading is fundamental. But at the end of the day, people get confused, and the form changes pretty consistently. Every 2 to 3 years, the form changes, and then the tax brackets change. So sometimes if you leave your taxes the exact same, you don't change anything from 2020 to 2024, your refund is gonna vary. The COVID came and there was a bunch of different tax changes that happened, so people had a ton of extra money and a bunch of big refunds. But then there was another one that came in 2023, so now a bunch of people owed with the exact same thing. So what I recommend is going to the IRS tax website. There's a calculator on there, and it is an extensive process. So this is not something that is, let me just sit down for 10 minutes and get it done. It's probably like a 30-minute, you have to fill out so much information, but it gives you the most accurate depiction of what you should be withholding. And then that's going to make sure that you are pretty much net zero. And then you can just adjust it a little bit from there. That's what I do on an annual basis, because the government should be factoring in all of the tax changes into the IRS tax calculator. So that's going to be the most beneficial tool that you can use. But if you're not willing to do that, read the form and then understand that some of the tax brackets are going to change year over year, and then you're gonna have to make some changes based on your level of comfort.
30 minutes is not really a lot of time. If it took me 45 minutes to an hour, but I know at the end of the day, at the end of the year, my take home will be a little bit more. But I got to make sure that I'm not wasting that take home.
Right.
So my take home will be a little bit more. I can throw some of that in my 401k or throw some of that in an investment form or in an investment fund. It's worth it for me to go to irs.com. And what am I looking up? Tax calculator?
It's the tax calculator, yeah.
Love it. All right, cool beans. I really think that this idea of tax season being all about the big refunds is a mindset that we have to shift. I used to, particularly as a young person, I would be so excited. Oh, tax refund season, tax refund season. And then when I began to get a grip on it and realize, wait a minute, this is the amount of money I was overcharged for taxes. I adjusted my exemptions, but then I started looking for ways that I could get tax breaks. So of course, having a house, having kids in school, paying interest on anything, all of those types of things, I could get those breaks. Are there breaks what are some of the common breaks, or are you aware of this? What are some of the common tax breaks that people are overlooking?
Biggest ones would definitely be any kind of earned income credits that most people might be getting, just depending on where they're at kind of in their tax bracket kind of level. On top of that, like you just said, the child care tax credits, your office, if you're working from home, you can usually write off portion of that in your taxes. Interest payments, student loans that I feel like a lot of people, even if they are paying their student loans, they forget that they can write off the interest on those. Some medical bills.
That's a biggie right there. And most of us are still paying. We had some breaks, thank God, but most of us are still paying student loans. So that interest on the student loan and that's like an easy form that comes in the mail, or you go online, you can download it and you're good to go. So that
both, they usually send it both to you.
Yeah, and that money that you paid towards that is money that you shouldn't be taxed on.
Correct.
And I think that's the part that people are missing, that, first of all, knowing what tax bracket you're in. Most people don't know how much they're paying in taxes.
You also have to look at the way that you're filing, because as Roman said, like when you're writing off interest and things, it depends on the way that you're filing. So if I was to file married, then I can automatically write off some additional interest on like student loans and stuff. But if I file as married filing separately, then I can't. So things like that. It's little things like that, those idiosyncratic things that the IRS doesn't allow you to write off versus does. Those are the things that a CPA is going to know and understand. But those are things that you have to know when you're actually filing your taxes and filling out your W-4 forms. It depends on the way that you fill out the form. And that's going to adjust what you can actually write off. There's additional write-offs if you are married filing together versus married filing separately versus single. Like all of those things are going to change the trajectory of how much you're going to end up paying or how much you're going to get back as a refund.
I think it's interesting, one of the things we hear a lot about the rich is that the rich don't pay taxes.
Don't. They don't.
Roman is shaking his head like, nope, they don't.
They don't.
And it's
I
not
don't
that
know
they
when
don't
this
make
is coming
money.
out.
Yeah. But
But
so
most
many of their
billionaires only pay
expenses,
8.2%.
8.2%. How
And
is
the
this
average
even
American pays
possible?
like 25, 30%. So
Wow.
So
And
here, when I get rich, I plan on doing the same thing, running
me
my
too, man.
money,
That's what I need to know how they do it.
running your money through LLCs, and start treating yourself as a business. So if
Yeah.
I set myself up as a business and I say, you know what, I'm going to buy this house or this car or through the business. So I set up
Yes.
Zion Mason LLC, right? And I
Yep.
put myself in, let's say, Montana, where the taxes are a little bit less stringent. So now Zion Mason LLC is set up in Minnesota or wherever. And I say, you know what, I need to purchase a house, but I'm going to purchase the house through the business. So now Zion as an individual isn't being taxed for the house. It's my company that's being taxed. But
Yeah.
well, my house needs a new roof. So I'm going to use business credit and I'm going to put the roof on my business credit card in Montana where I'm being taxed less, even though I live here.
Wow.
And, you know, like just finding those avenues of running things through businesses, LLCs, corporations, stuff like that, and keeping things away from you as an individual. That's how, I think was it Roman would probably know, like, was it Elon Musk that took like no money? He just took like a bunch of stock options for.
yes,
Oh yeah. So at the
a
end of
few
the year, he's
CEOs
like, I
would
didn't make
do
any
that.
money. That's why I don't owe any taxes.
Exactly.
Mhm.
Yep, a few CEOs. That's why a lot of their you'll see you hear the compensation is like 125 million, but their actual salaries maybe only 25 million, and they got 100 million in stock options. So it's how they
Wow.
structure and kind of lay those things out. But especially if you're going to do all that, you definitely looking at the CPA and a lawyer, but you
Yeah.
come with extra costs. You got to think about those things when you think about, oh, I'm gonna set this up to get rich quick. If you maybe only making 50K or less a year, this still may not necessarily be the option for you. I'm still leaning more towards the standard deduction and trying to set up all those things. But if you got
Yeah.
more money coming in and you want to start making more use of it, that's definitely a case to do it.
I did a little bit of research in preparing to even talk to y'all, and I so appreciate again just taking this time to talk about young people and their interest in money. And I'm always reading white pages and polls and all that stuff, but there was a poll done by CNBC and something called Generation Lab, and they discovered that 61% of millennials and Gen X or Gen Z are not saving for retirement each month. In fact, just like pretty much not saving every month. 61%.
Yeah, I mean, because you look at most every other financial expert's suggestion for where you need to be to save for retirement is that by the time you get 30, you should have your year's worth of salary already saved up in retirement. And I don't know even too many people in my own circle that I can go to, and by the time they're 30, let's say their salary is 80K, is going to actually have 80K saved up in the bank for retirement.
Wow.
And when you think about those statistics, it makes people get disheartened about trying to save for retirement because they're like, well, if I got to work through anything, I might as well go to that Taylor Swift concert. I might as well buy those extra tickets or do this and might as well live instead of saving. But I don't know. I still encourage people to save because no matter what, you're going to need that money in the future. And the more you work at it now, the quicker it's going to build.
One of the things I like about y'all's conversation is it makes it doable, because it can seem extremely overwhelming when you hear these numbers. And some of these young folks, I mean, I have a COVID grad, one of my 3 daughters graduated during the pandemic, and I feel like she's doing well, but still picking up traction from even coming out of school during all of that. And so when you hear these numbers, like you should have this much saved, you should be saved, they want to save and they want to invest, but they don't really see us like, where's the starting blocks for all this? How do we even get started in investing our money, and what should we do with it? Like where should we invest it? So what advice would you give somebody early 20s to say, I'm cutting my costs, so I'm saving money. I have a little savings account, but what else should I be doing?
The biggest thing when you're looking for employment especially is checking in with your employer to see if they offer 401k. And if they offer 401k, get enrolled. But then you ask if they have a match. The match is where people are missing so much money, and that's just free money. So let's say my company, let's say that they give 5% for every 10% that you invest. If I invest 10% of every check, then I'm getting half of that money for free. So that right there is the biggest way for you to just get more money very quickly. You're getting,
so your company is basically contributing to, you're contributing, and they, in order to encourage you to save, they said, if you put some money in, we'll put some money in.
We're going to match you dollar for dollar for every, $50 that you put in. We're going to give you 25. So when you look at it that way, you're actually losing money if you don't invest in 401k. And then in addition to that, a lot of companies have profit sharing. So when you look at different profit margins and they do a calculation based off of how much they actually made that year, et cetera, then everybody gets a percentage of that. And then you may get another $4,000, $5,000 that are just added to your account annually. So when you're looking for employment, those are two things that I always ask. Do you offer 401k? Do you offer a match on the 401k? And do you offer profit sharing? Those three things are going to allow you to see your account to grow exponentially each year. You'll see your account go, pretty steadily, and then it'll shoot way up because you've gotten a discretionary payout. And I'm like, that's free money. That's free money. Go get that.
And who would pass that up? I think that when people are looking for jobs, that's not a question that they're told to ask. They're looking for, how many vacation days do I get? How much are you going to pay me, and how many days off? But not a lot of folks know, hey, I need to be thinking about how I'm going to get out of here. And even being willing to leave a job for a job that pays you the same amount, but is they'll match my 401k. And one of the things I'm discovering, and I love this generation for it, it used to be kind of a little bit of shade to say, this generation, they don't want to stay at any one job. They want to go from job to job. And I'm like, I'm happy for them. Because
and another one on top of that is even an HSA. You can get a lot of jobs have those. And if you don't know, it's a health savings account. It's really almost kind of like basically a retirement account for your health costs. So by the time you end up getting old and you got to pay for living expenses and healthcare and medicine and all that, that's basically a tax deductible money you can take out of a health savings account later on when you actually get sick. That's different from your 401k. That also can grow tax free without any worries. And a lot of jobs actually offer that with their health insurance plans. And it's money that people don't even think about to do.
I'm so glad you brought that up. I love the health savings account because if you don't use it and then you try to itemize at the end of the year and not, how much money did I spend on my health this year? You try to go through there and try to itemize and then say, I spent this much on my health, so I shouldn't be taxed on the money that I spend on my health. It's so much easier to go through the health savings account because that money is taken out before taxes, right?
Right. Yeah. And also like a FSA versus HSA. So FSA is a full spending account. That's money that you kind of are guessing to spend that year on your medical expenses. Whereas HSA is kind of more long term. That's something you put away when you're like 25, and then when you're 60 and you got to pay for those healthcare costs, you kind of want to take them out then. So that's kind of how that goes.
I see. So what I was referring to was a full, what's it called? Full spending account?
Flex savings.
Yes.
It's flex savings.
Yep. Yeah, some jobs kind of go back and forth, but that's what that is.
I remember it. Now I remember it. It's like flex spending where I have I remember even having a particular card when I worked in a corporate environment. You have a card that you spend this money on anything related to your health, and that money isn't taxed.
Correct.
So
they
sometimes
just
saving on taxes has to do with not paying it in the first place.
Exactly. Yep. And it also applies to dependent care. So there's money that I allocate towards, let's say, child care, right? So I'm going to be spending money on child care already. But at the beginning of the year, when I'm enrolling in different plans and stuff, I enroll in those two things. I enroll in the flex spend account, so my FSA, and then I enroll in dependent care. And let's say that I max it out. So I may have $8,000 sitting in both of those accounts. Money I'm already going to spend. I go to the dentist and I have a copay. You swipe that card. You don't use your personal card. You swipe that card. Then you are paying for childcare and you use the dependent care card. So you're using that money anyway, but then when I get my W-2s, it's going to say this money isn't taxable. So let's say I was going to make 100,000, they subtract that 8,000. So now I'm only being taxed on 92,000. So
smart.
I'm not taxed on that money. That's another good way to not have to pay taxes, but there are caps on how much you can allocate to both of those accounts. and legally they're not going to let you go over that, so you don't have to worry about
Right.
it. But I max them out every year because I'm like, I'm going to spend money on something.
Right.
You know,
You're gonna
last
do
year I
it.
was like,
And it's
get
easier
braces.
to do it within the system
Mm-hmm.
than to try to itemize later, because you're more likely to forget, or you're more likely to just not do it and
And you don't
figure,
have to track receipts. You know, track receipts is, you know,
yes.
we're not doing that.
And you're trying, because we know we're not. We say we are.
Mm-hmm.
We say we're gonna do it, and then we're just not gonna do it. So, who's your favorite money mind? Who do you guys listen to? Who do you read? Who's your favorite money mind?
Go ahead, Zion. Take this one first.
Take this one first. I'm trying
Yes.
to think. So I'm going to say that it's my mom.
Okay.
So there are obviously a lot of brilliant people in the world, but
And your mom's an amazing business owner.
Yeah, she is. But that doesn't mean that she's rich. However, the mindset and the understanding of how to use money and how to do certain things and being able to set myself up the way that I have is in large part because of the teachings that I got from her. We were reading Who Moved My Cheese. We were reading books by Robert Kiyosaki. We were reading those types of books as kids. So I would attribute a lot of my ability to work money now because of how I was raised and how she brought me up. So I would say her, and then I would also add like a Robert Kiyosaki in there, and those types of money minds.
I think it's interesting, this idea of, because you really were raised by a visionary. And I always tell your mom, she's extremely prophetic. Your mom she's a wise woman, and she has a lot of guts. She has a leadership gut, meaning she's willing to, like, there's some things people can't stomach. Like, there's levels of discipline that people just can't stomach. And your mom has that ability. And it's interesting that when you're raised by people that have certain qualities, if you're a smart kid, you're going to follow.
Yeah.
And not, pull against
Don't tell her that, though. You know,
if you're a smart kid, you'll be like, okay, I'm going to peep mom's game. What is she doing? Oh, that's how she makes that work. Because there are many days I'll call your mom and be like, okay, this is what I'm thinking about doing. And she's extremely wise, and she has a leadership gut. Yeah. All right, sir, who's your money person?
Mine is actually a lot of the people on the team of the marketplace and Make Me Smart cast from like I don't know what came pronounce his name, Kyle Riznoff and Kimberly Adams and Molly Wood, all those people who kind of work over there. It is a really good reporting and sometimes a little biased, but usually mostly kind of unbiased, kind of like lookouts on the economic markets and everything for it without nothing added to it, without trying to sell you something on it. It is very clean economic news and insights, and that's what I like. I used to be I was a very big person on Dave Ramsey for a while, until I was the person who was like, well, you can't really not use any credit. Like, you got to be able to leverage something. I thought this is my early days. Yeah. So so like when I was first coming up, when I was searching,
particularly in the church.
Mm-hmm. Yes, because he's very big into that, very big in the church community. And then I was growing up and I was trying to figure out money, and he's like one of the first people you see. So you're like, well, okay, what he's saying does make sense. You know, get those baby steps in. But then as you start to get more financially literate, you're like, there's more to money and investing than just kind of what he's saying. So I grew beyond that, and it got through some YouTube stars and such. And I was like, you know what, the marketplace people, I feel like just do a really good job of just presenting economic news and teaching people and lessons that a lot of people just need to know. I like them.
But I think at the end of the day, financial literacy is something we have to take responsibility for. Just understanding how money works, how money grows. I even talk about how money can kind of ebb and flow. I'm working for myself. This will be August. It'll be year 2. So I have always had a full-time job and a side hustle for decades. Like, always had a full-time job and a side hustle. I teach my daughters, never have just one stream of income. And so now, working just for me, I work for me, but I have 5 different things that I do, right? Mm-hmm. But I'm learning, even in the 5 different things that I do, there are seasons where money is flowing, and then there's seasons where money is ebbing. And learning not to freak out during this.
Go with the flow, know that it's coming.
know that it's coming, go with the flow. Yeah, not freak out. My bookkeeper is like, you're fine. Are you kidding me? You're fine. You look at from 1 month to the next and like, what's happening? So learning that money can move, it ebbs and flows. And so learning how I have an investment fund that I just give to automatically.
Yeah. And
I kind of put it in a crock pot, like set it and forget it. Is that wise, or do you think I should be? What should I be doing with it?
Especially primarily index funds, I'm guessing.
It is, absolutely.
Yeah. Yep. Set it and forget it. Maybe check it once a quarter, maybe to do a rebalance, maybe once a year for a full year rebalance, but set it and forget it. It'll just compound and grow and do its thing. And unless you want to be more active, go ahead. But people invest off of emotion. So if you look at it one day and it's down 5%, you're like, oh, I got to sell it. I'm going to lose all my money.
Yeah.
But next week it would have went up 25%. But if you sold it, you wouldn't have made up that money. So let it ride. The stock market usually always goes up. It doesn't always, but annualized, it goes up at least 10% a year. It does. So you'll be better off there.
Especially if you're looking at your portfolio when it comes to like your 401k, if it's going up and down, but you also have the mindset of understanding that some of this money was free. Like I didn't put in some of this money. Like if you look at it like that, then the ebbs and flows also don't matter as much. So yes, you always want your portfolio to be increasing, but if you're looking at your portfolio like on a daily basis and you watch it go down and you start pulling your hair out, like you have to just let it. Exactly the same mindset. You leave it, continue to invest, understand that at some point it's going to go up, it's going to correct itself, because my financial advisor came in and spoke to my entire corporation and everybody was freaking out last year. Everybody was freaking out last year.
Yes.
And we had a lot of calls and a lot of things, but then they came back this year and everybody was fine. And we were just like, just leave it there. We will be okay. They're like, I'm retiring in 5 years. And I was like, we'll talk in 4.5 years then. Like,
and you'll
relax.
Be all right. Yeah.
We'll be okay.
Okay, so I have to ask y'all this before I let you go, and I've really enjoyed your intellect. At the time of this recording, Kellogg's cereals are sitting on the shelf. Because the CEO of Kellogg actually went on television and instead of addressing corporate greed as the cause of prices going up and food being less expensive, he recommended that people feed their children cereal for dinner. And cereal is probably one of the most processed, unhealthy things you can give your children or yourself. Cereal should be like a treat, like Saturday morning, maybe 2 Saturdays a month. It's so processed. They strip it down. And then, how they, anyway, we won't get into that. Yes. But so of course, so their stock starts plummeting. Now my heart is with the people because I believe in a people-led revolution. And my pocketbook is like, should I snatch up some of that?
Well, it depends on what part of Kellogg you're in, because Kellogg did split recently into 2 separate businesses where they have the cereal side and the snack side. So if you still got some of the snack side, you might keep the snack side. And if you feel like you just don't want to support the company, by all means, there's sometimes you're like if you don't support them, sell it. If you're like, that's fine. But sometimes
their price is dropping like crazy.
It goes with it, but it is Kellogg. They probably will rebound and level off and come right back up because they're still a 100-year plus or at least 50-year-old company by this point, and it'll chill out. Sometimes it is sometimes good to go with your moral gut as a sense of like, you don't want to invest in cigarette companies, you don't want to invest in gun companies. By all means, then don't. But there is some cases with like index funds where yes, your money's in an index fund, but the index fund itself is probably still investing in that. So there's some cases where our money will divide up and you won't know it. But if you want to put your money directly there, then let them go, let them be, don't support, because it is a form of helping that out.
Absolutely. Any last thoughts for young folks or any folks that say, I know I should be putting my money to work. I've been working for my money. How can what would be like my first step in getting my money to work for me?
Open a savings account. You can just start with a regular account, and Roman and I have preached from pretty much day one that you have to have a couple of different accounts. You have to have And what I love to do, and what people never do, is set up their direct deposit to automatically go to different accounts. So I have a primary account, and that's my spending money. I have a savings account, and that's my emergency fund money. That's money that I'm just going to have in case of emergencies. That's if your tire bursts and you need $800 to get brand new tires. That's that money. Then you have a high yield savings account, and that account has a much higher percentage that you're going to be getting on a regular basis. And then you also have an account for your stocks and stuff like that. So my money is going to my 401k, it's going to my child's 529 plans, it's going into a regular savings account for emergency, then it's going to a high yield savings account. So I don't see that when my check comes and it says, yeah, you made $1,000, I may see 500 of that, because all of it has been diversified. And so now
and it's working for you.
It is. And I'm only operating based off of the small amount.
It's like there's got to be a heart gut connection that people have with their money. And people want to see, you know what I mean? Roman, I know you got something to say about this. Doesn't there have to be a shift in your heart and your gut in order to really make your money work for you?
It's a discipline. You have to get used to it. And personally, for me, it took me till about until I got my first investment account to like the first initial $1,000, and I've got almost like my first kind of real almost dividend payment, because I'm primarily a dividend growth investor, and it was only for like 11 cents or something, but I was like, it's working. I'm starting to see it come to fruition. And once you start seeing that kind of turn and be like, oh, my money is working for me, it's doing this by itself, and that's what shifted my gear. So I was like, I got 1,000 in here right now. What happens if I get it to 5,000? Okay, what happens if I get it to 10,000? And it starts to just kind of grow. And next thing that you see the money kind of start to compound and work for itself. And that's why a lot of people will say it's that first 1,000 that's the hardest. It's the first 10,000 that's the hardest. And it's the first 100,000. After that first 100,000 is saved up, you're gonna see that money start working a whole lot quicker. So it's a whole just discipline mindset. And like Zion was just also bringing up, it's the pay it yourself mentality. Yeah, he may have not only seen that initial 500 after that 1,000, but the other 500 went other places. Not like he lost the money. Some of it went to a spending account. Some of it went there. So all he did was pay himself first before he paid all those other bills. So that's the biggest change in that. Don't think you're giving away the money. No, you pay yourself. Putting money in savings is paying yourself, not anything else.
And then you still get that additional money that you're talking about. You're still getting that on a regular basis. When I look at my statements and it's like, yeah, you made $47 in interest this month, it's because I put that money in that account first. I threw that money in there first, and that's a $50. That's free money. So I'm just going to take all of that, and my children's accounts that are automatically getting money, they're seeing the compounded interest as well. And they're 6 months old. They're so small. So by the time they get to my age, they're going to have more money than me.
Yeah. And I think there's something about, in order to get my money to work for me, I have to fall out of love with money. Like, I think it's a mindset that people have where we're so emotional about money that we do what the money tells us to do, rather than telling the money what to do.
Yeah.
Do I sound crazy? But you know how it feels
like that. You have to be willing to let it go in order for it to grow.
I gotta have it here. I gotta have it in this one account. Where put that money to work, and you made the money. Now you can put the money where it's gonna work for you.
Exactly.
Yep. I don't know. I like seeing my accounts rise a little bit by themselves without me doing anything. When you wake up in the morning, you wake up in the morning, it's like, oh, this just went up, and I didn't even go to work yet today, and I already made some money. I can almost call off today and not even be okay. So it makes you. That's what they do. That's what the rest of every other rich person does. They're like, oh, I've already made my dollar for the day.
I think one of the greatest hindrances to savings is FOMO. What advice would you give somebody who's suffering from FOMO?
Start now. If you feel like you missed out beforehand, start. And when you mean by FOMO, you mean like missing out on the next investment opportunity or missing out on living?
Missing out on fun right now, because I'm not going to go out tonight and spend $70 on a meal, $20 at the movie theater. I'm going to stay home.
Well, it's really in that budget. Like you just said, paying yourself first. If you pay yourself 20% of that money, there you go. Use that 20% to live and have fun and do this and do that. Now, when that 20% run out, that means you spent that 20%. You shouldn't spend anymore. But in that just depends on just being smart about your budget on that case. So I don't know what you have to add on that one.
Because with my method of splitting your money up, I also have an account. So my one account has 3 different accounts attached to it. So that's my primary. So I have a savings account, I have a reserve account, and then I have like a spend account all in one bank account. And I'm like, so the money that I actually have to pay bills goes into one. The money that I have for fun goes into another. The money that I have for savings goes into my emergency fund. Then I got my high yields, and I got my other account set up over there. So I am a big advocate for being able to do fun things and get things that you want. Like I'm big on that, but it's all within moderation. Like, just the same way that if you're working out, like you don't want to just do it all in one day. You're not going to see it all in one day. You're going to have to do it in moderation, change little things here and there. And those are the things that are going to add up over time and allow you to, one, enjoy yourself, but then also see your accounts grow. But if you're not one of those people that is like, you know what, I love seeing my money grow, maybe you like seeing your debt decrease. What I like to do is
find the right motivation.
Yeah, I like to write out every time I get paid. I write every account that is owed. Student loans, car note, what's the total amount that I owe? What do I have to pay? When is it due? And I have a spreadsheet of everything that I owe. And when I scroll back to 2 years ago and the amount was $200,000 more than it is now, I'm like, we're doing something. So it's based off of, what is your motivation? Are you motivated by the fact that you're gaining money, or are you motivated by the fact that you're decreasing debt? Same thing, different way of looking at it.
I love it.
And I think you spoke on something really key there, and that's track. We didn't even talk about it yet, or not plastic for me, but you're tracking those finances, those money, using Rocket Money, using Empower, using a spreadsheet, writing it down. When I first started really serious, I wrote everything down in a financial journal because it allowed me to see it on pen and paper, where my money was, where it was going, what debts I had. And it almost was just keeping your own self accountability for it. So doing little things like that.
That we see that help us like consolidate, you can see where everything goes. You recommend those really work.
Yes, or even your bank. Usually your own bank will have those apps or some type of way of doing that. And sometimes you can't sync them all together. I know Apple, I think even has some way to do it. Even Google Wallet has it. Use whichever one you think is best for you. Just make sure your passwords and stuff are really safe.
He's like, good old school, write it down, huh?
It's the black book. It's you just keep a black book on you, and everything that you owe forever is in there. And you can just look back and reminisce on, man, I used to really be broke. Like I used to really not have money. And now you like, I have money and I have less debt. And I love that.
And I have less debt. I love it. Any other advice y'all want to give?
Go watch Young Broke.
Start investing today. Go watch Young Broke and Investing.
Go watch Young Broke and Investing. And you don't have to be rich to start investing.
Yeah. One of the things that we did was Roman's got $1 million sitting in his account, but I didn't. I started my account on the YBI journey with $0, and then we watched it grow to, I don't remember what we got it to a couple years ago, maybe $2,000 over the course of like a year and a half. Yeah. But we literally started with zero. So somebody that's interested in starting an account, you can literally watch the process of me bringing up the entire account, what I invested in, how I did it, how much I made. And we did a check-in on that pretty consistently for like a year and a half.
Yeah.
And where can we find it? On your YouTube channel or on the podcast? Where can we find it?
Both.
You can do both.
All right.
YouTube, so you can see the visuals.
Yes. Go to YouTube, check out the visuals. Listen, you're never too young to get started. You're never too old really to jump in, because you're right. That FOMO works both ways. You can you can choose which FOMO you're going to have, honestly. You got fear of missing out on fun. You just create a fund account, and you do have some fun. You say, this is what I have to have fun with, and this is what I'm going to have fun with. Or if you don't do that, you're going to end up on the back end, 70, 80 years old, talking about, why did I not invest my money? What did I do with all the money I made? Now where is it? So listen, y'all are geniuses. I love the way you think. And I love that you make it possible, because sometimes it can seem overwhelming, too hard to learn, or just, I don't have enough to get started. And I love the fact that you can start an investment fund with how much?
$50.
Zero. $5.
$10.
Wow.
There's so many ones you can do it now. We're having $0.
And we talked about a couple weeks ago, I opened a brand new savings account because they were like, if you bring us a new account, you get $300. So money that I'm already using, money that I'm already obtaining, they just wanted direct deposit to that account specifically. And they were like, the same money that you're getting direct deposit, we're gonna give you $300. And then if you open an investment account, again, it was free, you're gonna get some free stock. So I got 3 or 4 free stocks, and I got $300 just for having the same money. So I'm not afraid. The same way that people are like, I'm gonna jump jobs and job to job, I'm gonna jump from bank to bank to bank. Whoever's gonna give me the money right now, whoever's got the best high yield percentage, I'm gonna walk with you guys for now. And then if somebody else, switch it again. And then so you can start with nothing, literally nothing,
and still get rolling. And I love this idea of going where the money is. I opened an account just recently at a bank because they had the same thing. Invest $1,000, leave it in for 90 days, we'll give you $300. I said, bet, do it. Do I have to leave it in? No, seriously, do I have to leave it in there when I'm done after the? No, you don't have to. Okay, great. I'm gonna give you $1,000. 3 months later, I'm gonna come back and take $1,300 out. And that's $300 that I didn't have to work for. And then I can take that $300, throw it in an investment account, do something to just keep that money working for me. But y'all have inspired me. I need to make more money so I can invest more money.
Don't we all?
Start growing up some funds. I know that's the goal for all of us.
And also have fun. I think a part of one of the ways it's going to help people stick to a budget, and maybe I'll have y'all on and we can have y'all come back and we talk about budgeting tips, because I think one of the ways that people don't stick to budget is like a diet. You're so focused out on what you're not doing rather than look at what you can do. And short-term thinking will cause you to get, frustrated emotionally. But if you think long-term, you think about my future self is going to really thank me for this. So appreciate it. All right, fellas, thank you so much for being a part of the Culturalist podcast, because money is everywhere and we need to know how to make it work for us.
Yes, thank you so much for having us.
Go check out this YouTube account. I was watching it earlier today. These guys are a lot of fun. Young, Broke, and Investing. I was saying Young, Broke, and Still Investing. Go check it out. It's real talk for real people. And can we drop questions in the YouTube account? Or okay, super, because I know people are going to have a lot of...
Hit us up on Instagram, or hit us up through our email account too. We'll respond to those too.
Great. We're going to put all of their contact information in the show notes. So go check it out. Y'all get your shmoney and make that money work for you. Blessings.
Thank you so much, y'all.
Thank you. Peace.